everybody. Still working on pillar number 2, and that's the income strategy. And just to do a little review, just to make sure everybody understood what we did there, is we basically explained how the income strategy is really a process where you buy an equity and you put on a call option and a put option, and want the stock to trade in this kind of price channel. Our example was GE trading between 28 and 32, currently trading at 30, and with that we're able to generate, really on a weekly basis, a very nice return. We call that return income. Our goal is to do that every week if possible. Now, how do we find these equities? I'll call it the what. I call that the, what to buy and when to buy. This is where all of the background processing is being performed on a nightly basis. And a lot of people call this process, algorithmic trading. We use processes to basically come up with the opportunities. So what does that mean? What is an algorithm? Well, it's just that. An algorithm is a set of processes and I'll call it mathematics and decision-making points where you take the data and you pass it through that process, and if it comes out as a positive result, then you say that is an opportunity to take a look at. So we do that on both questions, what to buy and when to buy. So what about the what? How do you determine the what? Well, the what is based on the fundamentals of the underlying equity. And what are some of those fundamentals? Well, the major ones are market cap. How big is this company? Number one. How many shares per day are being traded? Set of numbers, okay, that we put in place to basically filter the equities being looked at. So those are two of them. A third one is, I'll call it earnings per quarter. Every company reports their earnings each quarter, and we're going to look at that and see, is it positive or negative? Not so much concerned about the exact number. I'm more concerned, is it plus or minus? Because I've found that if you can find companies that have positive earnings each quarter, you have a better chance of that company stock price staying stable. And that's what we want. We want companies that have stock prices that are very stable. So that's a key element. Another key element is something we call revenue growth. Revenue growth, positive revenue growth, is kind of our desire, because I have found in all of my analysis that anytime a company is not growing their revenue, call it year over year, that something is going wrong. In other words, what is their product? What is their market that they're in? Is it under pressure, or are the company products deficient? Is competition beating them up? Because any company, to be successful, has to grow their revenue year over year. If they're not growing, if revenue growth goes negative, immediately becomes suspect. What's happening internally in the company? Number one, they've either added too much staff, their expenses have gone up, and when that happens is, if they're not growing their revenue, it's going to very quickly affect earnings. It may take a quarter or two, but once that they're on that kind of trajectory going down, revenue growth wise, in 2 or 3 quarters they're going to be negative, and what's that going to cause? It's going to cause the stock price to go down. Okay, so that is a key element. Revenue growth, I've discovered, is one of the top key elements in the fundamental. Second one I would say is quarterly earnings. And the third one is something that I've come up with as a term called bare cash. So what is bare cash? Bare cash is the assets the company owns, cash in the bank, and they may own equities, they may own other assets that can be sold so they can get access to the cash. So it's that ownership of those assets that they have less their long-term debt. I call that bare cash. So if you have more assets and cash versus debt, you have the opportunity to have a positive bare cash, which is good. It gives the company sustaining value where if, let's say, their market does change, let's say the stock market goes down, the economy goes down, they at least have some reserve to fall back on. Companies that are highly leveraged, in other words, their asset minus their long-term debt is very negative, as soon as they run into trouble on the economic side, it affects them very quickly. And the only way they can survive is they have to downsize. The company has to take action to reduce expenses. And how is that done? It's the only way you do it is downsize. You either sell off product lines. In a lot of companies, if you're in the retail space, you close stores. You find out which underperforming stores you have to get rid of. You have to reduce expenses. And that's happened a lot in the retail industry. There are a lot of malls, okay, that are closing because the retailers have left. So it affects, it's a kind of a domino effect. So the key is understanding that and sorting out those companies, okay, that maybe have a lot of negative bare cash. We don't need to step into that hole of if we invested in them and they got into trouble, their stock price is surely going to be affected. And it's usually affected to the downside. So we want to find those companies that have positive bare cash, have revenue growth, have quarterly earnings positive. If we can find companies that at least meet those criteria, and the other criteria are market cap, we like companies that are like $1 billion at least, and that are trading at least maybe 200,000-300,000 shares a day. In other words, we want them to be followed by institutions, that they have high volume in the stock market, so that if we want to buy shares or sell shares, there in fact is a liquid market to do that. We don't want to have to say, well, I'm going to put this order in and wait 2 days for it to get executed. We want to buy those stocks where that gets executed within seconds of placing an order. So the key is its volume. Shares traded per day is a very important factor. So if I take those variables, okay, and I find those numbers for every stock out there, I now can build a set of filters. Okay, so every night I can get the data for all of these companies, and there's about 8,000 stocks to look at every night. And these are the ones that do have volume. These are highly traded stocks. These are not pink sheets or over the counter. There's another 10,000 companies to look at that are totally, I'll call it questionable in my mind. They're very high risk. And we don't even look at them. We don't even bother deciding, oh, this is a new company, it's an IPO. It has all this opportunity in front of itself. The problem is, if it doesn't have positive bare cash, does not have revenue growth, and doesn't have positive earnings, why even start investing in it? You may have some risk capital, go ahead and do that on those companies, but it's not the type of companies we use in the strategy to generate monthly income. We need high quality companies that have very good fundamentals, and that's why we are highly successful, because we filter out all of the junk. We throw it away. We don't even look at it. If it doesn't pass the fundamental test, why even consider it? And there's sometimes some companies on that list that are in trouble. Okay, they may have negative revenue growth. They may have negative bare cash. And the last 3 quarters were negative. We don't need to consider them. Okay. Maybe, 6 months from now, they may turn around. They may get their act together. Well, let's wait for 6 months. We'll be patient with those companies. They may be big names that just because, they're a big company in the marketplace does not necessarily say that they're going to be successful. We're going to do it by the numbers. And this is so key to success. Trust the numbers, trust the data, because I'll call it the process, the data analysis that's taking place every night is so huge in generating success, is that you yourself, the human mind, just cannot process the information. You can't even get the information quick enough because there's so much of it. So we rely on the computer process and that type of filtering and algorithm to, number one, find what to buy. And every day we have 80 to 120 opportunities to look at that have passed the fundamental test, okay? And that's key, okay? Because once we find that, okay, we have good companies, have good, good data in the fundamentals, we now want to look at the question, when do we invest in this company? And that's another set of calculations, another set of mathematics, call it an algorithm, where we're not going to take the past trading history, okay, of these stocks and determine, is it the right time to invest in them now? Now, the algorithm we use there is very sophisticated. I used to have, I'll call it formulas and data points that I use to have one formula for all stocks. Well, I've determined that every stock needs to have its own algorithm. And how do we get there? It just takes a lot of compute power. So we're going to take every stock, take their trading history, take their volume and call it momentum of what they're doing, and we're going to process that every night for every individual stock that we want to look at. That'll answer the question of when. So what the algorithm is looking for, it's looking for those stocks that have gone through a recent low point. It may be their 52-week low, it may not be, but have gone through a low point and now are moving in an upward direction. And one of the key variables, okay, in this algorithm is trading up days. In other words, call it a scoring system. You get points for every day that the stock goes up. You get points for every day the stock is trading near the 50-day moving average. You get points if the stock, in fact, has traded in a certain range for a certain period of time. So we add up all these points and use that as a mechanism to establish the when. And basically, when we hit the right number, and every stock has its own number, it's basically, I'll call it a buy signal, and it varies from a number of 71 to 100, and that number gets set based on how this stock performed in the past. So this algorithm then is processed on each one of these opportunities of what to buy, and now it'll tell us, here is a buy signal. This stock is now trading in the right range, has had the right history in the past, could be 20 weeks, 50 weeks, depending upon the stock. The algorithm knows for each stock what that period of time is. It will say, here is an alert. Take a look at buying this equity now because it is trading in this pattern for the last X number of days. And once that happens, now we have the two pieces that we need to decide, is this a good opportunity for us to take a look at? And think about the process. If that's done every night and you end up with 60 opportunities at the end of the day or in the morning, you have 60 opportunities to say, which one of the 60 will I take a look at? You're not looking at 8,000, you're looking at 60. The system already has said it's on the what side, it's good in the fundamentals, and on the when side, it's the right time to take a look. Because we don't want to buy stocks, for example, that are trading at their 52-week highs. Because what can happen? I buy today, tomorrow it goes down 5%. We don't need to do that, okay? I'd rather buy a stock that's trading lower and has the opportunity to go up 1% or even stay flat. Remember, the income strategy is I want to own something, I want to sell options on that ownership. And as long as the stock trades in a narrow channel, we're going to be very successful. In fact, we are 95% successful. And the system is very efficient at finding those opportunities every day. And that's basically that algorithm that says, here is when to invest. It has taken out a lot of the guesswork. And the other thing it has taken out is, I'll call it emotion. If you trade by the numbers, don't let emotion overtake and say, well, I don't believe what the system is telling you. Too many people say they're smarter than the data. They have some other knowledge outside of the system, fine. But the data in most cases is pretty good. It's pretty correct, okay? And it may actually see something that you're not seeing. Because people that get emotional do one of two things. Number one is they don't execute the trade because they don't believe the numbers. And then later on they say, I wish I would have, could have, should have, because they didn't believe the numbers. Or they were correct. The stock went down. But remember, we're going to buy the equity. We're going to sell a call and a put. We now have some downside protection. We have some premium to work with. And unless the thing tanks, and why would it tank? Well, the only reason stocks tank in a lot of cases is earnings day is tomorrow, and we don't know what's going to happen. Or there's an economic disaster, or there's a, I'll call it a geopolitical disaster, right? We had a big earthquake, or California slipped into the ocean, or we had Korea, sent over a missile. It has to be a catastrophic event. Okay, normal trading in the stock market, things go up and down, but they're not going to go down 10, 20% in one day. It has to be a catastrophic event. Of course, everybody's going to get hurt in a catastrophic event. I don't care what your strategy is. If you own equities and the market goes down 20%, it's going to drag everybody down. There is no way you're going to protect yourself against that. You can't predict it. The only way is to protect it is maybe have some insurance on inverses. In other words, you own some indexes, you own the inverse that go up when the market goes down. We have some of that strategy available for people that are very nervous. But otherwise, the strategy is we're going to own good equities. The algorithms determine us what to buy, when to buy. That's going to give us a high success rate, and we're going to be able to basically sell calls and puts on these positions and generate that monthly income. So the algorithm is key in the sense that it's generating the signals to when to buy, and trust the data. If you think you have more information you can apply, fine. But if you really need to be very close to the company, either you're an insider or you have some kind of inside information, fine. I mean, that's great if you have that. But in most cases, it's emotional. And I think if you trade by the numbers, get the emotion out of the way. Put on the trades and go enjoy life. Okay? Because the market will be the market. You can't predict what's going to happen tomorrow. But if you're in good equities, in the right equities, the what, and in them at the right time, you're going to put yourself on the right side of the curve to be very successful.